Hello everyone, and welcome to another episode of my M1 Finance portfolio series where I'm attempting to reach a $100,000 portfolio in this platform, M1 Finance. I've been doing this for 20 months now, so 20 episodes of the series, and the portfolio has grown quite a bit since its humble beginnings when I started with zero in this account, and we're up to $55,000, or actually closer to 57 when you count the cash value, which will be deployed at some point in the near future most likely, and I'll be continuing to add new cash to this account as time goes on. Right now, I've still been focusing quite a bit on paying down more margin since I did take out margin to fund part of the purchase of my new home, which will become a rental property at some point. Wanted to stay liquid otherwise, but the new cash that's coming in is mostly going towards debt paydown. I had my basement flood that has kind of thrown a wrench into things by another month or two of actual income that's going to be coming in. That's really going towards that, as much as I'd love for it to go towards stocks instead. But anyways, fact of the matter is, over time, I'm going to continue adding money to this portfolio so it can continue to grow. And if you want to see all of my holdings for a particular episode, I always include a link in the description below, and you can go ahead and dive deeper into all of my specific holdings and the approximate weightings that I have for each of them. Granted, it's not an exact weighting, it's more of a target allocation, and you can adjust that as you see fit. It's not financial advice by any means, but it's a nice little feature that M1 Finance has, and that you can actually copy other people's portfolios into your own, and you can take portions of it, you can adjust it, like I said, but it's just a nice little feature. If you actually use my affiliate link down in the description below, I might get a small commission if you end up funding your account, and ideally you'll get a great brokerage out of it too, since M1 Finance does have a lot of nice features, and I really just love the interface above all. Granted, that is not the only thing you should worry about when you're picking out a brokerage. But because of all the things I mentioned earlier with my basement flood and the new home purchase, I haven't been focusing a ton of time and energy on this actual portfolio, so there hasn't been a whole lot of changes, just adding a little bit of money here and there, maybe adding a little bit to some positions, mainly Alibaba. I've been throwing a few $100 at every now and then since it just continues to get battered down. I know the actual money weighted return says I'm down negative 67%. I'm actually not down that much on an absolute term since a lot of this money is pretty new. So I've lost about $165 on something like 1,200 or so that I've actually invested into Alibaba. I don't know if I'm going to invest much more into it. It's a very complicated business in that there's so many different subsidiaries to it. And also you have the massive risk, well, massive depending on how you want to weigh it, but a significant risk, we'll say, with the CCP and different risks with investing in China. Granted, every geographic location is going to have its own sort of risks, but we're seeing it really play out immediately right now with Alipay, for example, is being threatened to be broken up by the CCP. We have various sort of donations or penalties, whatever you want to call them, that are being thrown down on some pretty big firms in China. Alibaba is not excluded from this. So there are different risks there, and it really is just going to take a lot of research to get more comfortable with it. Assuming I would get more comfortable with it if the research I find actually is more positive than negative and pushes me towards adding to it. Right now, it's been more of a kind of a cloning trade in that a lot of value investors that I admire have been buying into it. So you could call it a sort of value investing FOMO, but shameless cloning was kind of the initial push towards investing in Alibaba, but that's kind of been it. I don't have a ton of conviction myself, at least at this time, and I kind of want to see where the dust settles with sort of investing in China in general, the political risks associated with that, not only because I'm a US investor, and that could cause some problems, certainly with how it's listed with the ADR structure. There's just a whole host of issues. We actually did a pretty comprehensive discussion on Alibaba and some of those risks over on Punch Card Investing, the joint venture that I'm doing with a few other value investing focused YouTubers. So check that out. I'll be sure to include that in the description below. It's a weekly live stream where we talk about all things value investing. But anyways, for the meat of this episode, I want to go over REIT valuation, or really real estate company valuations. I do have a couple of real estate companies in this portfolio, namely Equity Commonwealth, that being my largest holding in this specific portfolio, one of the largest in my outstanding portfolio, and it's actually one of the largest in my general portfolio when you include Pershing Square Holdings, which is not available on M1. I used an over-the-counter purchase over on Fidelity, but that is my other largest holding. They're around the same size. I think the Pershing position is about 15 grand, and this is about 13.5 grand for Equity Commonwealth. So that is a very significant position. This is a REIT owned by Sam Zell, but really it's mostly cash. I've done some valuation work on it in the past. Granted, everyone's valuation work is going to be very different since it depends on your assumptions for growth and then also your discount rate, depending on how you're doing the analysis. So my valuation might not necessarily apply to you. do your own research is what I'm really trying to say. But I kind of want to talk about the framework of trying to value real estate and value a REIT in general, or a real estate investment trust. That's what REIT stands for, or just real estate companies as a whole. Because I do have another real estate company here, which I've been meaning to do a lot more research into. And I kind of want to show you how I would get started with that. That's FRP Holdings. This is a real estate development company, and they have a decently interesting looking portfolio, at least on the surface. Haven't done a ton of research, and I want to kind of go through my preliminary sort of setup to begin researching in this episode. So if you want to follow along with that, definitely stay tuned. Since the nice thing about real estate is when you can take a look at the portfolio itself, you can take a look at each individual property and value it accordingly based on the income it's throwing off. Because commercial real estate is really helpful in that way, in that it has a rather mechanical way to value things most of the time. At least if you're trying to sell something today, there are pretty set upon standards for valuing commercial property. And it generally follows this sort of formula. And that's this formula right here, which is the income approach to real estate, where you take the net operating income, which is your income minus your expenses before any debt. So we're not including debt here. And then you divide that by a particular cap rate, which is sort of like a ballpark metric for valuing that income stream. And when you put those together, when you divide net operating income divided by cap rate, the annual net operating income, then you get your sales price or valuation, whatever you want to call it. So based on the cap rate, or what investors are willing to pay for a particular income stream, based on the class of the building, the type of building, where it is, the sort of risks in a particular area with that tenant, there are lots of things that determine the cap rate. It's more of an art than a science, really, but this is how commercial real estate is valued. It's based on the income, more or less. And the cap rate applied to that income will depend on a variety of factors that are a little bit more qualitative in nature, but otherwise it all starts with that root of NOI, your net operating income. Other things can affect it too, depending on how you're purchasing the real estate. When you're looking at a whole company, you're going to want to take debt into account as well, of course, since you're not just buying a free and clear property where this is all you'd have to do. You want to look at the debt terms and see if there's anything there that might be cause for concern, or it could be a potential source of value depending on how the debt is structured and if people understand how it's structured. But anyways, this is the basic formula for analyzing commercial real estate using the income approach. There are other approaches too, especially with residential real estate. That's usually the comparables approach, where you're looking at two properties and seeing how similar they are and then basing it off of the sales history itself rather than any income that it might be able to throw off. It doesn't really care about that. It's just looking at what is a property that looks and kind of feels like this property sell for recently. That's the comparables approach. And the other would be the cost approach, which looks at the actual cost to replace the building, which is kind of infrequently used. It's probably used more in the development side or for really unique properties that might not have very good comparables or might be hard to put a sort of cap rate on. It is a rather niche-y sort of approach, but one thing that investors do sometimes use when appropriate, the cost approach, where you're looking at the actual cost of inputs to build a particular building or replace it. But broadly speaking, the income approach is the most common approach used for commercial real estate investing, which would apply to just about any commercial real estate company or REIT. So let's get back to FRP Holdings. This is a smaller cap real estate stock, $500 million in market cap with a 14.7 PE, though price to earnings isn't necessarily the best metric to use for something like a real estate company, because there's often so many tax write-offs like depreciation and that sort of stuff, which isn't actually a physical loss to the business, but is more of a tax loss that is actually advantageous to the company in many ways, since it can lower its tax bill and keep that money and plow it back into the business or whatever. But I want to take a second to actually walk through how I would approach researching a company like this, a real estate business, and seeing how I would come to a valuation potentially based on that research. So this is where I would start on the company page, see if there's any useful tips here. You could probably go up to portfolio and then you could see all the properties, and yeah, it lists out, it looks like all the properties, I think. And now FRP is interesting in that it has multifamily properties and that sort of stuff. And then it also has these big aggregate rock deposits like gravel and that sort of thing. So it's a mixed portfolio. It's not just, they're not a one-trick pony. And they're in a few locations throughout the US, including Washington, DC from my preliminary research, but also Florida, I believe, and some other places. Again, I haven't done a ton of deep dive research. I've been really meaning to though, but this can be a nice start. And if you're interested in this company, this could also be a potential springboard for further research too. So, okay, we're in the portfolio tab. You see the investors tab over here where you can actually get their quarterly filings and annual filings, any presentations they might have that could help for kind of understanding what their thesis is and what they're trying to do. So let's see, investor presentations. Looks like you could open up the annual shareholder meeting. And it looks like this, and this is from May, so potentially a little bit outdated, but we're only talking about 4-ish months. So it looks like they kind of summarize some of their metrics here. So we'll take a look at that at some point. But let's see, let's go back to the properties, because ultimately that is what matters when we're talking about a real estate company. The properties is where it's really at. And if they have a bunch of cash, then you might want to look a little bit more closely at the capital allocators. But from what I understand, they've been doing quite a bit of share buybacks, so that is a decent sign as a shareholder if you're looking to kind of have that extra sort of catalyst to build shareholder value, because the company is buying its own stock back if it thinks it is undervalued. And then anyone who still owns that stock after that would benefit, since there are less shares outstanding and your share thus becomes more valuable compared to the actual cash flow or value of the business. So that's how a share buyback could certainly help an existing shareholder. And they've been doing that from my understanding. But anyways, back to this portfolio, since we want to take a look closely at that. All right, so I've opened up all of the properties. We have this multifamily property in DC. We have this warehouse building in Baltimore. We have this another multifamily in Washington, D.C. We have this property in Maryland. It looks like an office building, I believe. They have another warehouse in Maryland, so mostly in that D.C. area, it seems. Another one in Maryland looks like some sort of logistics or distribution center, or maybe some light office, though that's a lot of parking. Another D.C. apartment. A South Carolina apartment, it looks like, maybe mixed use. Some of these are renderings, so I wonder if they're actually coming developments. We'll check back in a second. There's another one in South Carolina. Looks like an office, though it has balconies. It looks like it's actually apartments. Another one in DC. It looks like a residential development in Richmond, Virginia. This must be one of those rock deposits, some land in Maryland. Looks like another multifamily in Maryland. Another rock deposit, I would think, or would be quarry. It's weird kind of thinking of rocks as having value, but it's used in a lot of things, gravel and all that good stuff. So there's value in this land too, especially once you get the gravel out of it. And then you still have the land left over, which I'll return to in a second. But anyways, we have another development. Looks like this is under construction, or is this must be another quarry or rock deposit, I would think, in DC, at least if I'm looking at this picture correctly. And then we have another sort of distribution center looking thing in Maryland. So a mixed portfolio. We got a mix of kind of what looks like industrial logistics. We have the aggregate rock properties, and then a lot of multifamily, it seems, and I think some office in there as well, but mostly multifamily, then rocks, then kind of light industrial sort of stuff. So that's the portfolio we're working with. Now, what I would want to do after this, we kind of have a lay of the land. Most of it's in Maryland, so you might want to understand some of the risks with kind of Maryland real estate, if there's anything there. Come to understand the DC market and what might lie there. And with real estate, even if the overarching market might not be doing as great, you can look at the actual property itself, see where it is within that market. Is it in a super primo location that even if the broader market doesn't do very good, that one can always be I hate to use a rock phrase, but that can be kind of your steady rock in that market, because it's a really nice property. And even though the broader outskirts of that market might not be doing good, maybe that property could still be doing well. So it's location with real estate, no doubt. If you're in a super hot market, that's probably going to help you a lot more, but it's not necessarily necessary when we're talking about real estate for maintaining value. Anyways, so what I want to do now is actually try and get some of the numbers on these properties. And I would guess that would be somewhere in the filings, and that would take some digging to go through if they even itemize it by property, because they might just kind of give you a full net operating income for the actual portfolio. But that's the ultimate thing we want to do here. We want to approximate what the NOI of, or at least this is how I would approach it. I'd want to approximate what the NOI would be of the multifamily properties, try to get an approximate cap rate for that multifamily portfolio. It looks like it's all Class A sort of multifamily, so I'd want to use that cap rate, and then compare that to the NOI of those buildings. So that would be kind of the multifamily portfolio value. Then I want to do something similar with the kind of aggregate rock pits, depending on the value there. I'm not 100% certain how you'd value that if you're not actually cash flowing yet, and it's more in the future value of the rocks there. So I would probably kind of table that towards the end of my analysis. And I would also take a look at some of the other commercial properties like the light industrial, if there's any office, if I wasn't mistaken about that being office or not. And then do the same thing that I did with multifamily, get the NOI of that particular class of property, and then compare it to a relative cap rate and kind of get a ballpark valuation for this portfolio. And then we'll compare it to its debt, of course. Let's go on over to their filings again and take a look at their, go to their previous quarter's results. This is back from, looks like June. Wondering if we can get a little summary here. So again, you'd be going through some of these filings, seeing what's going on with the business. A lot of this actually applies to other stocks as well. Just kind of seeing what's going on with the business, what happened in the last quarter or two, last year, last couple of years, kind of get a general trend. What are their goals? What are they saying their goals are? They do highlight that they had a really good quarter with mining royalty revenue, or at least compared to their company history. So clearly that is a big part of the business, and you'd want to wrap your head around that aggregate business and kind of see what value might be there. But I think the thesis here, or at least the lens or hypothesis I'm going to look at this company through, is seeing you have the market cap of around 500 million. See if the multifamily or the industrial stuff that's a little bit easier to value, at least in my circle of competency, see if that is equal to the 500 million in market cap based on my own valuation work. And if it is, then the aggregate rock business, which seems to be doing pretty well, I don't need to know as much about it because it's almost like a free lottery ticket, assuming the multifamily and the industrial properties are worth what the current market cap is. And people are just kind of sleeping on these rock pits, which might be very, very lucrative. And it seems like that's a big part of the thesis. So that's kind of the lens I'd be going at it with and try and do some light valuation work on the parts that I can more easily value, at least in my own experience. And of course, if anyone in the comments has any thoughts on the aggregate business and has a decent value on it, definitely let me know. I'd appreciate that. That's where looking at some of the presentations might be pretty helpful, seeing if they say anything there. We can go check this presentation we pulled up earlier, see if they say anything about the aggregate business. You can see they do have some summary metrics here, so I'd want to come back to that. Let's see, rocks. Mining and royalty. Here's something. I got 15,000 acres, 13 properties. So I wonder if the properties on the site were even all the properties that they actually have kind of in operation for the mining and royalty side. It doesn't seem like it is because I only remember seeing a few. So that's interesting. So there might actually be many more than what we have here. Let's see, 506 million tons of rock. That is a lot, or at least it seems like a lot. I'm not a rock guy. So they're bringing in $10 million in revenue from just the mining. It sounds like they'd have more coming with all of that sort of stock. And I think this is the free lottery ticket. If you can come to a valuation for the multifamily and industrial side of the portfolio, if that equals the market cap, then all this stuff is kind of like you're getting it for free. Here's a summary sheet that I definitely would take a closer look at to kind of try and understand this aggregate business. They mentioned that sort of $8 to $9 million number that they brought in royalties for the mining. So what it looks like they do is they rent out the land to mining companies who will then actually take the rock. So they're selling kind of the mineral rights on a rental basis. That sounds consistent with what I understand about this sort of industry, or I think the same would go for something like oil or any natural resources. The actual owner doesn't really do the mining. In many cases, they'll actually rent it out to someone who does specialize in mining, and then the miner keeps their cut or something like that. And then the actual landowner gets their royalty on that resource, depending on what is actually taken. So anyways, without rambling too much, that is kind of where I'd be starting with FRP Holdings. Taking a look at the actual properties, seeing if there are any hidden gems here that might be relatively undervalued, and compare that to the actual market cap outstanding. I do have this kind of feeler position to incentivize myself to actually look more into into it. I would like to get this position much higher if I end up liking the actual thesis that I develop on this actual holding. And there's always a chance that I don't actually like it and I would sell out. So this is kind of my feeler position. That's how I would start my research. Hope that was helpful for anyone who might be trying to figure out how they go about even valuing a real estate company. Just try and start with the income as much as you can. Find a relative cap rate that would fit that property. And that would get you a ballpark in the actual sale value of the property using the income approach. If they were to try and liquidate it today, of course, you can do your own sort of valuation work, and beauty is in the eye of the beholder, and you can kind of discount the cap rate appropriately depending on how much risk you want to take or how aggressive you want to be in your assumptions. But anyways, that's where I would start. Take a look at the properties, take a look at the actual underlying income of the portfolio, and I would divide it into those sections: multifamily, industrial, and other commercial, and then the aggregate business would be separate. And I would see kind of what the approximate total value of the portfolio would be. And that's where I would try to find a margin of safety so that I'm getting a sizable discount on that actual value of the properties. And then ideally you'd have some growth mixed in there too. Even if they don't liquidate tomorrow, which you probably wouldn't expect anyways, you'd want to see some growth along the way too, and you'd be benefiting from that if the company is well run. Anyways, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about investing, whether it be in the stock market or in real estate, in this case, we had a nice meeting of both since it is a real estate stock. But even more broadly, if you like personal finance content, be sure to subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And I actually put out a new episode of this series every single month on the 15th. And if you're interested in M1 Finance and want to learn more, I do have a tutorial series that I have in the description below. And I do have that affiliate link down there if you want to sign up. Again, if you fund your account, I might get a small commission, which would very much help the channel out a lot. But until next time, take care.